I'm going to be looking at the Ftse 250 and also at the macro situation in the UK. Before I start this video, please remember I do these just for fun as a hobby and always speak to a professional financial advisor before making any investment decision. So I like to start with the long-term view, and we have the trend of stocks always going up, or the Ftse 250 always going up. And it's quite notable the changing gradient of that ever since the government and the central banks started their New Keynesian economics doctrine. However, ever since the government decisions following the Wuhan outbreak, things seems to be floundering a bit. And at my previous update, I had all kinds of options. But actually, where we are now, I think that we have double bottomed here, and it looks like we are in the all hail New Keynesian economics scenario. Now, here's the Ftse 100, but of course, this isn't really so useful as an index because there's only a small handful of stocks dominate its market cap overall, and most of the revenues for these companies are international. So we can expect the Ftse 100 to carry on regardless, as it has been, but it's not really of much use to me anyway. So here we have my macro dashboard, and we see that we are in really a mild stagflationary situation here, with GDP growth at around 1% and inflation at 4%. These are my own guesstimates based on the current quarterly times 2 plus the previous 2 quarterlies. However, we've got very low unemployment at only 4%. And of course, stock markets and house prices are doing great at the moment. So here I've got the long-term trend, and these are all annualized numbers. And we see that interest rates have returned to this historical norm of around 5%. Because of the government's COVID policies, we had this surge in inflation, but also GDP, but those are withering away now to quite okay numbers. Unemployment is really low, and we see that compared with historical data, its unemployment numbers are really good at the moment. And here we have the government fiscal deficit as a percentage of GDP and overall debt. It's not good, but it's kind of stabilizing. Really, the key thing here, I think, is the inflation. Although, of course, the government like to point towards the year-on-year data, because it's year on year, that isn't such useful data for me. And I like to look at the month on month CPIH data, and I package that into quarterly data sets. And from this, that's how I've got my 4.1% per year number that I think is where we are. Bear in mind that the May print of 0.4%, that would be well over 4% per year. So clearly, despite what the year-on-year headline inflation numbers say, the real inflation that's going on as of now is actually quite high. So inflation is still out of control as far as I'm concerned. Here we have the New Keynesian Economics Control Panel, which the Bank of England think that enables them to control the economy perfectly using mathematical models which they call the dynamic stochastic general equilibrium. However, this jiggery pokery has only been enabled by a series of deflationary forces that we've had the fortune of living under, particularly the growth of the internet, technology, and globalization. Now, the globalization and AI, I have question marks at the moment. I mean, the globalization, that's probably going away at the moment as a deflationary force. And then, of course, however, the AI, when it comes in, could be a new massive deflationary force, but I actually think that's a long way off. Against this, you also have inflationary forces, and currently, really, the supply chain is the main one, particularly with the fact that the Suez Canal is not really accessible to European and American ships anymore. But otherwise, there's not really anything actual to report at the moment. But these are things that we need to be keeping an eye on in the long run. And the situation certainly is a lot better than it was a couple of years ago. The other thing that enables this New New Keynesian economics is the fact that we have reserve currency status. So the quantitative easing and stuff, which the UK government's been able to do, a lot of other countries in the world wouldn't be able to do because they have much weaker currencies. So in terms of pound sterling, it is actually fairly stable at the moment. But when we look at the yield curves, here's what a normal yield curve is supposed to look like. That's a Japanese yield curve. Here's our yield curve, and you see unfortunately it's inverted. And so this really is why I've got this with a yellow warning ring around it, because although generally, yes, pound sterling seems stable at the moment, I do think we need to consider this inverted yield curve as a significant risk factor. Now, there's several ways that we could get back to a normal yield curve. One would be if the economy was to collapse or we'd have a proper recession, etc., then that would actually lead to deflation and inflation would completely disappear. And then that would allow the bank to lower interest rates down to 2% or something, and then we'd be back at a normal looking yield curve. However, another way, which is really my kind of base case that I'm working off here for my main portfolio investments, is that maybe the government will drop the base rates by 1% or 2%, but that because of our fiscal indiscipline issues that we have with government debt at 100% of GDP and the fiscal deficit at 6% of GDP per year, this will keep the long end of the curve relatively high. And so that's a kind of mechanism by which we could return to a normal looking yield curve, but without the crash. And that would incidentally also leave us ending up in the longer term trend of having interest rates around here, this 5%, rather than down at the 0%. So here's the actual individual data plots here, and obviously interest rates have stayed the same. Quantitative easing is being very slightly reduced, but not much. The year-on-year inflation looks great. However, like I say, when you look at the month-on-month, we're actually in a bit of an inflationary issue at the moment, and that's why I'm certain they won't be lowering interest rates at the moment, or if they do, they won't do for long. House prices looking great. The GDP, and this is very interesting because we were in a recession last year. Well, now we are out of that recession. You've got these two facts, two kind of top line facts of we're technically out of a recession. We're just coming up here off a double bottom in the Ftse 250. This does give me bullish sentiment, those two facts on their own. Unemployment's looking great. Government debts increased actually last month to 100% of GDP from 98. And GDP is about 2.7 trillion, as is government debt. And then down here we have the nasty fiscal deficit numbers. So overall, really, I've been exposed to a lot of negative news recently. People talking about problems with the banking system, the derivatives markets relating to the banking system. We've got the unwinding of the yen carry trade and the potential issues there. But really, when I just focus on my main data points I use for my macro, really what I see is we were in recession last year, and then technically at the Ftse 250, we hit the double bottom. We're back off to the usual trend. So for me, I'm getting deja vu here of like a 2009, 2010 feeling, because I can clearly remember around here we'd had a lot of bad stuff happening, but it just somehow didn't feel like enough people had been punished enough for all the badness that had gone on. And I can remember month after month, you'd hear news stories of factories closing here and there. But when I'd go to my local restaurant, it would still be packed full of people, and people were still spending money. People were still living off debt. For all the doom mongers, and I can clearly remember back here watching Peter Schiff and Jim Rogers videos. but doomsday never came, and it was actually 2009, 2010 was actually the start of one of the best periods you could be in the market for. So really, I feel like it's the same thing again. Things will be sluggish for the UK compared with the US to start with, but then you'll see the US race off, and then we'll be racing off ourselves in a year or two. So really, my base case really is that we've had a double bottom here. We're pulled out of recession, and it will be maybe weak for a year, but I think my base case here is that the worst is behind us. And it's all stemming from this new Keynesian economics model. And although I think that will lead to a major issues in the future, I still think we're going to get another run up of easy money. I still think that this model's got quite a lot longer to go before it inevitably collapses. So according to my base case, now is the time to start carefully picking different sectors within the FTSE 250. So that really is my overall summary for the FTSE 250, but now I'm going to start going into detail with some other items. So here I've got some of the different macro factors all put together. When I look at this, I can't help but think that when we had the Wuhan outbreak, the government made a mistake of too much quantitative easing, which then led to the rampant inflation. Actually, they could have just not done half as much, and maybe that would have been good. And the situation now is, I feel like we're back to this situation that we were up until the credit crisis in terms of the interest rates, and we're kind of at a kind of normal level. But that's because of this excess in quantitative easing, and you're going to have to wait for that all to work off before you'd be able to drop the interest rates back down to zero without causing the rampant inflation again. So here I've got some fiscal things, and you can see here how the government overreach following the Wuhan outbreak has led us to being significantly poorer than we were before when you compare the GDP to government debt. We actually, though, were in a net quarterly fiscal surplus in Q1, so that's a return to normal after a long time getting there. And here I have government receipts versus government spending, and you can see the government's actually spending 50% more than it was before the Wuhan outbreak. Here's government spending as a percentage of GDP, and you can see here before World War II we had a free market economy, whereas now we're effectively a socialist republic with over 43% of our GDP related to government spending. And then the retail sales, and you can see because of the inflation, although the value is perhaps slightly going up, the volume's down. This is very bad. And actually, this is kind of contradictory data to my base case that I announced in my summary there before. So this is something to definitely think about and return to. Maybe we see this pick up, but if we don't, then maybe we could get this recession. Here you can see how interest rates, when you go back to the 70s, where we are now is actually a kind of historical normal or low even. So one of my main base cases at the moment is that we're going to retain interest rates at around this level. Unemployment, you can see how great the employment situation is in the UK. Inflation, you see how horrendous it was actually, the inflation we've experienced the last few years. And here we have house prices. And when I look at that house price trend, as someone who just loves working with data, I can't help but just draw a line through it. And I'd argue that really house prices are continuing the trend they've had. Here we have GDP, and obviously, if my base case is right, we'll see this continue to go up. However, again, it's looking a bit jittery, and so if if the opposite happens, I need to really focus on that, as it would disprove my current base case. And the same with M2 money supply. Something that's interesting is I looked at the US money supply at my last video I did, and we got this really nice exponential curve. Whereas really it's not so exponential for the UK, and I find that interesting. I wonder if that's something to do with the dominance of the US dollar over the rest of the world. Well, we don't get the same crazy benefits that they do, which is something mirrored actually in the how our stock markets reacted as well compared with theirs. But this is something else that I need to keep a close eye on, as it could validate or unvalidate my base case, my base theory at the moment. Here's the yield curve since the start of the year, and actually our implied probability of defaults increased by 0.1%. And we see that whereas at the start of the year we were around 4% here, or even at 2% at 6 months previously. Obviously, base rates increased, which gives us this 5.25% number up here at the short end. But on the long end, we've seen it increase from below 4% at the start of the year, 2.5% last year, to just below 4% at the beginning of this year, to now we're moving towards 5% at the long end. So for me, the devil is in the detail, and this supplementary info, we've picked up a few things to keep an eye on to help validate my base case. That we've moved off a double bottom, we're back into this all hail new Keynesian economic trajectory, but because inflation's a bit on the high side, the government won't be able to lower rates. Also because of the issues with our fiscal indiscipline. So I hope you found this video useful, and see you at the next one. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.